Hey, Rebel Bankers, welcome back to the Real Estate Money School. I'm your host, Chris Noggle, and today I'm joined with a very special guest, Bob Fraser from Aspen Funds. So this is going to be an awesome topic. That's all I can tell you. You know, when we talk about money and different things on the show, we're always talking about how to raise money, how to find money for your deals. Well, this is the source right here. So Bob, real quick, could you just give everybody just a quick intro on kind of what you guys do at Aspen Funds?
Yeah, sure. We run several investment funds. We buy primarily residential mortgages, reperforming residential mortgages, and we hold those and pay our investors.
Oh, that's nice and simple. We're going to dive a lot deeper into that. But folks, so think about that. So they buy, you said performing and non-performing?
Performing, we actually have two different funds and two different strategies. In one fund, we buy non-performing notes. Another fund, we buy performing notes.
And for all of you watching, you know, performing notes are just good, you know, performing mortgages and good performing notes. Non-performing are the ones that we don't want, the ones that are having trouble. Maybe somebody can't pay. They, you know, I'm sure Bob will go into the story of how they turn them around. But it's a phenomenal business. I know quite a bit about it, but we don't personally do it. So I love talking about it. But before we get into Bob's story and, you know, kind of how he's gotten where he's at, let's talk about all of your journeys to becoming a Rebel Banker. So that journey begins a lot of different ways. You start seeking information. You figure out what your goals are. You seek out the knowledge and the information. Some of that's podcasts. Some of that's YouTube, all sorts of sources. But the biggest problem that we have found is it's easy to get knowledge. We're inundated in knowledge and information, but we fail to take action on so many of these pieces of information and knowledge that we research. And that's where the difference is made between somebody that's going to be successful or having massive success and somebody that's not. So on your journey to being a Rebel Banker, you have to realize that the application of knowledge is more important than the knowledge itself. So on your journey, folks, I want to challenge you with something. I want to challenge you to take advantage of something. Now, if I give you something for free, you're all saying, absolutely, I want that. But what if it requires you to do one additional thing? What if you actually have to take a couple steps? Are you willing to get the thing that's free if you got to put the work in? Well, we're going to find that out, because what I want to do is I want to give you a copy of my book, The Private Money Guide. Okay, the source to where all the money is, how to get it, and how not to ask for it. So if you want this book for free, all you need to do is go to chrisnoggle.com, go to the resources tab, scroll down 2 finger swipes to where it says free book, and click on The Private Money Guide. And we will send it to you. You just pay the shipping and the book will be yours. I want to see how many of you actually take action on that, because that will tell me, the audience, if you're action takers or just someone out there wandering around, gathering knowledge and doing nothing with it. So with that, Bob, let's get into this, man. I love this topic. Tell everybody a little bit about, like, how did you get to where you're at? You have 2 funds, okay? One performing, one non-performing. Like, how does one find their way into this business?
Well, you know, it's we got started out of the 2008 crisis. My partner, we started this in 2011, and he had lost everything in the crash, and had been a real estate developer, had a bunch of land, and across the United States, prices fell around 35%. Well, for undeveloped land, it fell like 75%. And so even though he had great positions, he was very wealthy, literally lost everything and gave it back to his lenders, and who, by the way, did fine. And so it was out of that he figured out something. It's like, hey, wait a minute, the guys that do well and over time are a lot of times the debt guys do better than the equity guys. And so he said, maybe let's take a look at the debt. And so we started looking at that, and he basically pioneered our business models around the debt space. One of the things that happens, I know you like to talk about, the challenges and the failures. And, the problem with that is that makes a very long show, because the list is long of those things. And I started a tech business in the late 90s. We raised $44 million in venture capital, and I lost everything in that. And then my partner lost everything in 2008. So what happened, and we got very sensitized to the market and to wanting to build something that really had a little bit more bulletproof character to it. And we picked debt as really the better place to be.
I think that's always a safer place to be. Equity, you're sort of just hoping and praying. And I think there's a lot of people right now doing a lot of hoping and praying in the stock market because from the way I see it, coming from the 16 years I spent on Wall Street, I don't like what I see right now. What are your feelings on what's happening out there in the environment? I mean, you own two funds in the debt space, and then let's talk just for a moment on the debt in the equity space. So equity would be, let's just talk as most people would know. You buy a stock. You're taking an equity position. Although it's very, very, very small, you're still taking an equity position, which means you have one guarantee. And that guarantee is you are guaranteed that you could lose all of your money. Now, in the debt space, it's a little different. It's just like a loan. That would be no different than, the bank makes a loan to you and then you have to pay that loan back, but it's usually securitized by something. So if you fail to pay, that bank goes and takes the money back. So that, and you could even get into bonds with that, but really just trying to keep this high level and simple. So, what are your feelings about what's happening right now in the equity world?
Well, in the stock world, when I say equity, I mean the equity in the real estate market, but in the stock world, I actually ran a hedge fund for a while. I was
That's a perfect topic then.
So, and I ran a macroeconomic global macro strategy and had been very successful for 5 years. And then 2008 hits and I got creamed. And that's no fun, when you taste those kind of times. And that's what led me to, I'd rather do something that had more control, in the stock market. The price, your stocks are only worth what someone else is willing to pay for it. And if everybody's fearful and panicked, well, it could be, what everybody says it's worth is far less than it's really worth. So in this last crisis, I was looking at, I just picked up some bank stocks. There's banks that are selling for 20 cents on the dollar of their assets. So literally, of all the debts they own, they're selling for 20 cents of that. And you know what? It's overdone. So I basically backed up the truck in March and bought a bunch of bank stocks, and I did well. But the market is fickle. It is just fickle. It is volatile, and it's interesting. These wonks that invest your money, these Wall Street types, they have one playbook, and it's just buy stocks. And the truth is. And they say stocks are more safer than alternative investments, which we run. But the truth is stocks are incredibly volatile. And, I counted like EQR, which is the equity real estate. It's a REIT, which pays, I think, something like 5% dividends. It had since 2000, I think 7 drops of over 20% just since 2000. And people think this is safe. The stock market is safer than rental real estate? It's not. And it depends on what you do. So I wanted something with a lot more control. And that's when I got in, I liked real estate based stuff. And we built our funds, and I actually have a stock price for my fund and a net asset value, but it's based on accounting. It's not based on the market, which is superior in my opinion.
Well, yeah, that's how they should all be.
It really goes one direction. It doesn't go up and down. And, it's much, much better when things go one direction, in my opinion. So, and not to say it couldn't go the other direction, but it's unlikely
Right.
based on what we've built. So, I think the stock market, there's obviously a place for it. There's some great companies out there, but, I choose not to play much there unless there's a fire sale,
Right. Which we're going to probably see another one of those very soon. So you can get the trucks all fueled up and ready to back up, and you'll probably have your pick of everything. I did the same thing in March. I took a ton of capital that was just sitting on the sidelines and privatized banking policies, and I just moved it all in, bought Tesla, Apple, all sorts of stuff. And
well, you did well.
I did. I sold out maybe too early because I'm so skittish on the markets that I took my gains. I mean, I was like,
Hey,
I'll be happy if I make 10 or 20%.
it's never a dumb idea
No, I thought it was
to cash in on some gains ever, and
absolutely.
leave some meat on the bone for the next guy.
I love that.
When you try and pick the top or pick the bottom is when you just get greedy, and just it's okay, So no, that's a win, But I'm actually long term, I'm probably bullish the stock market, to be honest, and the reason is when interest rates, when the Fed is buying, right, and generating, creating liquidity like they are, the stocks go up. So we're talking macroeconomics, which I actually wrote an economic newsletter for many years, and so I was a hard money guy. I expected in 2008 and 9 when they opened the spigot and started purchasing mortgages. They purchased, I think, $3.7 trillion worth of treasury debt and mortgage debt. I thought, okay, it's over, hyperinflation. Well, it didn't happen. So I basically completely restudied everything and figured out that there's not a big problem in doing that. And so when they did this stimulus that they just did, I said, it's time to buy the stock market. It's also time to buy the real estate, but it's time to buy all assets. So the truth is, easy money produces inflation, but let's realize there's two kinds of inflation, right? There's consumer price inflation, right? Which we all think is bad. Yep. But there's asset price inflation, which we all think is good. And that's when the stock market goes up and the real estate market goes up. So the truth is, when they make money easy, it does cause inflation. It just doesn't cause consumer price inflation. It causes asset price inflation. So long term, buy real estate. Long term, buy the stock market. Now, I think my stock market may be at a little peak here, but long term, I think it's when the Fed is printing money like this, and it's not just the Fed. It's when you look at zero, you have negative interest rates in Europe.
Negative interest rates.
So you're a money manager and you're managed $10 billion in euros, 10 billion euros, and you're paying your bank $100 million a year to sit on this money in their bank account. What are you going to do? You're going to do anything but that, right? You're going to take that money and you're going to get a currency swap and you're going to buy anything. You're going to buy Apple stock. You're going to buy commercial real estate. You're going to buy anything. And that's what happens. It creates a massive push. Money goes where it's loved. And so it's going to go. It's going to go overseas. It's going to go everywhere. It's going to go into undervalued assets. It's going to drive up asset prices. So do not short the market in this market. Do not short real estate. That's a dumb idea.
So with real estate, let's get back to the real estate side. With your funds, let's talk a little bit about like how you arrived at doing these. I know you were trying to find something that really didn't have all that volatility in it, and you arrived here. So let's dive a little deeper into Aspen Funds in terms of what you do and kind of just the inner workings of the two funds. And let's talk about some opportunities for the people listening.
Yeah, sure. Well, for the reperforming fund, it's super simple. Instead of think of it like rental real estate. Without the renters, so you don't.
I already like it.
When was the last time you called your mortgage company when your toilet backed up? So we don't get the calls. What that means is we can scale. The other thing that's very interesting about this business is we buy this debt at a discount. So we'll buy a $100,000 loan. And we may buy it for $50,000. So literally the borrower owes us $100,000, but we're only into it at 50. And so that makes our yields really high. So if it's a 7% coupon, but I bought it at a 50% discount, I'm earning 14 yield on it. And the other thing is then when that home is sold, I don't get $50,000, I get $100,000. And so I have high yielding and I get a capital gain when that home is refinanced or sold. And so this basically, my assets self-liquidate, as the homes are 8% of my portfolio self-liquidates every year. And it's a profit event for me. So it's an extremely cool business model. We buy a lot of second mortgages, which and as soon as I say that, everybody says, "Oh, that's really risky." I'm like, I'm so glad people think that, because that's why I get them so cheap, is because everybody thinks they're super risky. And the truth is, it's a sliding scale. If you have a $300,000 house and a $100,000 first and a $100,000 second, would you rather buy the $100,000 first at a 3% yield or a 4% yield, or a $100,000 second that you paid $50,000 for and you got a 14% yield on it?
Well, probably the second. The
I'm going
math
to take the
seems to
second
work.
all freaking day long. And the truth is, I'm not going to lose a dime on that in a foreclosure scenario or a non-payment scenario, and I'm going to earn a whole lot more money. I have a lot of upside. So I'll take seconds all day long, and everybody, all the traditional donut makers out there think that's risky, and I'm super glad they think so, Yeah,
more meat on the bone for you. Is it banks that you're buying these from?
Mostly we buy from hedge funds. So what happens is this is the byproduct of non-performing hedge fund shops. So a lot of folks buy non-performing debt. And one of the outcomes of non-performing debt is performing debt. So, and then once the hedge fund does that, they're done, right? They've done their part. They've made their nice gain, and now they want to flip it out. They want to flip the debt out. So that's primarily where we buy.
That's interesting. So when you buy it, what work do you have to do on this debt? Do you have to do anything to bring it to a performing debt, or like what's?
No, this is all performing. So the work is underwriting, like real estate, right? They say you make your money when you buy it. Well, it's very much the same. You need to understand not only the real estate. This is like buying a piece of real estate. We underwrite the real estate, but we also have to underwrite the borrower, and we have to underwrite if there's a senior mortgage. We have to know the status of the senior and understand what can happen to the senior. So it's a much more complicated underwriting process. But then once that's done, it's pretty much mailbox money.
I like that. Everybody likes mailbox money. So, I mean, do you use your own money? Do you use other people's money? Like, how does someone get involved in this? Or is it just
OPM?
Okay. So let's talk a little bit about OPM, other people's money. It's a lot of people's favorite topic. I literally wrote the book on it. So let's get into it. So what would someone do? Like, it's strictly accredited investors, correct?
Yeah, that's right.
Okay, so quickly, just for the audience, they may not know what accredited investors means. Could you just give them the definition so that they understand that?
Yeah, accredited investors, what the SEC in their infinite wisdom have decided that people who can invest in private placements must be accredited, which means you're earning $200,000 a year for the last 2 years and expect to do the same this year, or you have $1 million net worth excluding your primary residence.
Right, and do you verify that? I mean, is there a third party you use? You do it on in-house?
We are required by the type of offering we make to verify that. So, but that's not as painful as it sounds. Your CPA can sign a letter, or your wealth advisor can sign a letter, or there's a firm that will evaluate it that we don't even see all that. So,
okay. Awesome. So if someone wanted to get involved, what does that look like? What do they need? I mean, we already know they have to be accredited, so they have to fit in that little square box, but what can they expect?
Well, we're paying 9% yields. We pay it, and it's with full liquidity, believe it or not. So
full liquidity.
Full liquidity. So as I said, one of the very cool things about this fund, right, is that we have an internal liquidity mechanism. And so 8% of our portfolio self-liquidates every year. That means somebody refinanced their house. So when their house is refinanced, the old lender is paid off with a new lender. So if we're the old lender, we get a check. And that check is also a profit event for us. So, but we get this cash. So what happens, an investor can write us, and we ask for 90 days notice before the end of the quarter. And so we'll just reserve. We have X amount of redemption requests. We simply reserve. We don't go shopping that quarter. And so then we send the money back. And the price, so it's basically a full redemption. We allow you to put money in or to take money out every quarter. So it's a very unique kind of investment. And these assets allow us to do that.
Yeah, I was going to say that is very unique. Most of them have a set time amount, for the amount of time they have to
Of
be in
course,
before they have
because it's
any
real estate,
liquidity.
you're locked up.
Yeah.
But we have I think we have around 500 notes in this fund. So something is always going to be liquidating. It's like having lots of little bitty loans that they just pay off. So there's always liquidity.
Oh, that's
We've
fantastic.
never not met a liquidity request.
And the investors that invest, do they get paid monthly? How is their
Monthly. Yeah,
distribution?
you get an ACH to your checking account monthly.
People love that.
So yeah, I mean, we make it simple, make it easy. We do reporting. We get a nice quarterly newsletter that gives all the financials. We're really, we play, I call it cards face up management style. We don't have anything to hide. So give everybody the financials. We write a letter to explain what was happening. When COVID hit, we're very transparent, saying here's what risks we're thinking there. We're not sure what we're seeing. We're not seeing much yet. It turns out we sailed through COVID. And are sailing through COVID. So which all of a sudden has gotten everybody's interest. Now everybody's like, wait a minute, how are you doing this? So
Yeah, that is interesting because I know, with a lot of the deferments and,
right.
all the moratoriums and everything, a lot of people have dropped interest rates in the private fund sector.
And it's not us. I mean, we are seeing a higher delinquency rate, but our fund is built for that. And people are also very adamant about keeping their homes at this time because they're sequestered there. So yeah, it's, we're actually breaking records. This quarter is our best quarter ever. And the last one was the best one before that. So
hopefully that just keeps on going. The best one, the best one, the best one.
Exactly. Exactly.
Fantastic. I mean, so what else should we talk about with the funds? I mean, because this is an interesting topic. It's different. Some funds, that we've had other fund managers on here that, talk about their funds, and usually what they're doing, they're raising money and then lending that money out. But you're just buying the assets.
Oh, no, yeah. The first trustees, the hard money lending funds. Yeah, those are, those people got creamed, a lot of them in the crisis. And here's a big difference between us and them. And they don't buy at a discount. Okay, so they don't have that major cushion that we have. They generally don't have the same liquidity. But even if they did, here's the biggie: it's owner-occupied real estate. Okay, so if I'm loaning money to an investor and they're running a business, and that property suddenly has negative equity in it, right? So all of a sudden, the loan is worth more than the property is worth. What is that investor going to do? They're going to hand the keys back to the lender, say, here it is, right? But if you have negative equity in your home, the Zillow value pings below, your equity. Are you going to call your lender and hand them the keys to your house? Tell your wife and kids, well, we're sleeping in the bus tonight? I mean, no. So home sweet home, huge difference. In fact, I can show you a chart that shows that the foreclosure rate is not correlated to the equity. It's correlated to the job market.
Sure.
So this is a completely different business. Again, we want to build something that's pretty bulletproof, and so we do 95% of our loans are owner occupied loans that we own. This is home sweet home. Somebody lives here. This is where their kids go to school. This is where they work. This is not a profit enterprise for them.
And did you see so when COVID hit, you've kind of sailed through, but do you see any headwinds coming, in regards to the unemployment numbers and people not being back to work and, the economy?
Yeah, I mean, as I said,
heavily on unemployment.
Yeah, our delinquency rate rose. We were running around a 5% delinquency rate, and it's up to around a 10 right now. But our models really anticipate that. We actually underwrite to a 30% default rate.
Wow.
So as long as the default rate is under 30%, we're going to pay our full preferred return and have no problem. Okay, and we're not even close to that.
You underwrite down to a 30% default rate.
Yes. So
wow. That's the advantage of buying at a discount.
So we build, when we underwrite, we build, it's, you're a finance geek, maybe, you understand a discounted cash flow model. We look at every possible scenario for this mortgage. Okay. The first forecloses, they stop paying on their first, they stop paying their second, they refinance in year three. We look at about a dozen different cases. We come out with a discounted cash flow for each one of those. In other words, what is that worth to us if they do that? And then we weigh them by probability based on our experience. Well, that is a weighted discounted cash flow. We have never yet paid that much for one of our loans, believe it or not. These things sell at a massive discount to call it their intrinsic value. If that's the intrinsic value based on mathematics, and that mathematical model that we build has a 30% default rate built in. And we've never paid that much for a loan. It tells you how inefficient the market is. So these things are selling for way below their intrinsic value. And so basically we built the models, and, it's working. You never know. I've been through too many crashes to say, yeah, it's always going to work, but there's always a new kind of crash, It's always funny to me. Everybody's preparing for the last crash, but I promise you one thing about the next crash. It's not going to be like the last one.
Right.
Okay. So you can prepare all you want for the last crash, but I promise you whatever's coming is going to be different.
Yeah, no, it definitely smells different, looks different. I don't even know what to compare it to be honest. So if people want to learn more about your fund, like how do they learn about it? Is there a place they can go to kind of read up on it? What would be the next steps? Aspen,
like the tree, funds, funds.us. And great way to learn about it.
And we'll put that in the description so that anyone that's interested in checking out Aspen Funds, very unique, folks. Like if you haven't looked at private funds or anything like these alternative investments, like first and foremost thing you'd find is liquidity isn't usually a word used. So The fact that this fund has liquidity makes it incredibly different than all the others out there. And a 9% 9% yield is pretty darn good, especially for that the fact that there's the liquidity. And gosh, I don't really know what else to say. It's definitely worth looking at it if you're accredited and you're looking for an alternative place to park your money, and it's not the stock market, not the bonds out there. This might just be the answer to you. And if you need an income, I mean, what better than a monthly check coming in your mailbox? I mean, can't beat that, folks. So check out Aspen Funds. And hey, listen, I appreciate you coming on the show and talking a little bit about this, because it's always good for people to learn more about what's out there and what they can do with their money.
Great to be here with you, Chris.
Absolutely. Well, thanks for your time. And folks, as we talk about this, like every single episode, there's something new we're talking about, some new, golden nuggets and pieces of information that you can use and apply in your lives, in your finances, and in your businesses. And this is just another one of them. So make sure you check out Aspen Funds, give it some research and give it some serious thought. That liquidity feature, I mean, I know too much about this stuff, and I'm like, wow, that is freaking awesome. So yeah, with that being said, folks, go out there on your journey to becoming a rebel banker. Remember that challenge. I'm giving you a copy of a book for free. And all you need to do is go on the website, chrisnoggle.com, go to the resources tab, 2 swipes, and you can get a copy of that book. And that book will show you where all the money is for all the deals you're looking to do. And it'll show you not just where the money is, how to structure your deals to have a better chance at getting that, and how not to ask for money. Wouldn't it be nice if you could raise money without asking for it? Well, that book will do that. And another thing, while you're on the website, scroll one more down. There's a preview video on there that you need to watch. So check it out, and also join us for the next episode. Thanks, everybody. Real Estate Money School. We'll see you on the next episode.